The upcoming U.S. labor report is anticipated to have significant implications for both stock markets and the Federal Reserve's monetary policy. Analysts and market strategists are closely watching for signs of economic weakening, as a disappointing jobs report could trigger both a stock market sell-off and prompt the Fed to implement a substantial interest rate cut. If the August payrolls report reveals job growth below 100,000 and an unemployment rate exceeding 4.4%, this could lead to a sharp downturn in equities, especially in tech-heavy indices like the Philadelphia Semiconductor Index. A sell-off in this sector could send the index plummeting by 16% to around 4,000. Current forecasts project a gain of 165,000 jobs and a slight increase in the unemployment rate to 4.2%, according to Bloomberg's survey of economists. In the event of a weak labor report, especially if job gains fall well below expectations, the Federal Reserve might be prompted to cut interest rates by 50 basis points at its September 18 meeting. This would mark a significant shift in monetary policy, with the goal of preventing an economic stall. In such a scenario, U.S. Treasury yields could fall significantly, with the 10-year yield dropping from its current level of around 3.7% to as low as 3%. Meanwhile, the dollar would likely weaken against major currencies like the euro and yen, and oil prices could tumble towards $60 a barrel. Conversely, if the labor report meets expectations, showing job growth in the range of 150,000 to 175,000, markets could view this as a sign of a soft landing for the economy. This outcome would likely lead to a reversal in the outperformance of defensive stocks, benefiting sectors like technology and energy. Nvidia, which has surged 116% year-to-date amid the artificial intelligence (AI) boom, is particularly vulnerable to economic data. A disappointing jobs report could amplify concerns that the AI frenzy driving Nvidia's growth may have been overhyped. The bond market has already been experiencing gains, with the Bloomberg U.S. Treasury Index up 7.5% since April, and two-year yields dropping by 130 basis points. Despite the rising belief that the Fed could initiate its easing cycle with a 50 basis point cut, there remains considerable uncertainty about the ultimate direction of policy. In summary, the labor report holds substantial sway over market sentiment and the Federal Reserve's policy path. A weaker-than-expected reading could trigger a stock market sell-off, with tech stocks and semiconductors facing steep losses, while strengthening the case for a significant Fed rate cut. Conversely, a more moderate report could stabilize markets and diminish the likelihood of aggressive monetary easing.